This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Back in the game with the Dow at a record, many are wondering if the individual investor is piling into stocks again and what it may mean for the market's next move.
Economic powerhouse China's leaders are meeting to set a path for the world's second largest economy, and its outcome could have an impact here at home.
And hiring our heroes, what businesses large and small are doing to help veterans make the transition from active duty into the workplace. We have all that and more tonight on Nightly Business Report for Monday, November 11th.
And good evening, everybody. I'm Tyler Matheson in Washington, D.C. at the Schwab Impact Conference. It's the nation's largest and longest-running gathering of registered investment advisors, and it comes at a time when the Dow is at a record high, the S&P 500 near one, and many, but by no means all in the investment community, saying the individual investor is back and buying stocks. Susie?
Thanks, Ty. Good evening from me as well, everyone. I'm Susie Garup. On Wall Street, stocks kicked off the new week to the upside. But with the bond markets closed for the Veterans Day holiday, trading was subdued. Still, any move up for the Dow meant a new record. And that's just what the blue chips did today. The index posted its 35th record for this year. The Dow added 21 points, the Nasdaq edged up a fraction, and the S&P added 1 point. So, with the Dow at another new high and the S&P 500 just a point away from a new all-time close, where are we in the markets right now? Are we in the middle of an extended bull run or on course for a slight pullback? Dominic Chu takes a closer look at the pros and cons of what could happen next.
With just weeks to go before year-end, many investors are left wondering what to do about their stocks. Should you keep riding this bull wave higher, sell some of your winners, buy stocks now? The responses vary.
Our age is right now much more conservative, especially in this economy.
Disney stock. I love Disney stock. It goes up, it's made me money, so.
I bought most of mine at the record lows.
What's changed in the last year is that I personally just don't trust money managers.
The uncertainty doesn't change much when it comes to the view from the market professionals, the experts. On the one hand, you've got the optimistic camp. Oppenheimer's chief market strategist, John Stoltzfus, is one of those bulls. He says corporate earnings continue to flow in, and for the most part, they've been better than expectations. Economic data in the U.S. is also improving, and Europe is slowly working its way out of recession. Even the market for initial public offerings of stock is heating up. Those can all be interpreted as bullish indicators. On the other hand, the cautionary signs remain evident. Mark Newton of Grey Wolf Execution Partners is keeping a close eye on small cap stocks. They've been underperforming larger cap names lately, and that may indicate that stocks could be due for a pullback. Paul Hickey of Bespoke Investment Group is looking at market sentiment. He says that one indicator to watch is the Investors Intelligence Survey. It now says that 55% of respondents are bullish. The last time it got to that high level was back in May, and the S&P dropped around 5% back then. The important thing to remember here is that no one can predict the future. Even the experts disagree on where stocks head from here. For Nightly Business Report, I'm Dominic Chu.
Well, as Dominic just mentioned, and as we saw in today's Wall Street Journal, many investors are putting their money back into stocks 5 years after the financial crisis, and just as the U.S. economy seems to be gaining a little bit of steam. Well, here at today's big Charles Schwab Investor Conference in Washington, the individual investor was never far from anyone's mind. After all, the 2,000 registered investment advisors in attendance manage the money of thousands, tens of thousands of affluent retail investors. But when I asked Schwab CEO Walt Bettinger what he was seeing in his retail business, his answer was a bit of a surprise.
So, Walt, there's been a lot of talk that the retail investor is back. Is that what you're seeing in your business?
Well, it's really not what we've seen if back is defined as people pouring into the equity markets. What we have seen is investors are highly engaged with their portfolios, but we don't see them saying, I've got to be in the markets, I'm putting all my money in, the market's going up, this is the time to buy stocks.
When you say highly engaged, what does that mean?
Well, it means that they're looking at their portfolio on a regular basis, they're planning around their portfolio, they're looking at the long term, but they're certainly not timing the markets.
Are they afraid? Are they complacent? Are they bullish? What?
I think they're concerned. 2/3 of our clients have indicated that they expect a market correction sometime in the next 9 months. That's a pretty high statistic for us historically. At the same time, they know that being in the markets for the long haul is probably the right strategy, so they're not looking to bail out either.
When Chuck Schwab started this company, one of the selling points was that we were going to give the individual investor a fair shake, a low commission. They were buying and selling stocks. Is that still the main part of your business, or is it more sticky money, less trading money?
Well, it's an important part of our business, but it's a very small percent overall, maybe 15%. The vast majority of our clients today are long-term strategic investors. And today what we do is provide services that help them manage that money, I think again at a great value, just like Chuck started out with, but it's a quite different business model than it was 40 years ago.
I assume some are still buying individual equities, but an awful lot of them are buying ETFs, aren't they?
You're exactly right, Tyler. Individual equities, for the most part, have been replaced by ETFs for many investors. The idea of buying that single company and hoping you're right just doesn't measure up to buying a portfolio of companies. So ETFs continue to grow.
We're here in Washington for this big event, 2,000 registered investment advisors. How concerned are your clients about what they see going on in Washington? And are they more concerned about the budget and debt mess, or are they more concerned about the Fed?
I think they're a lot more concerned about the Fed. I think many of our clients look at the politics of what goes on in Washington and they almost brush it off. It's been going on for so long that it's not something that drives their decision making. The Fed, on the other hand, is a whole nother story. The Fed is pumping money into this economy, buying their own issued debt, the Treasury issued debt instruments. No investor knows how this ends up. How does this unwind? And that causes a lot of fear among long-term, very wise and sophisticated investors.
So what you seem to be saying is that the Fed, by its actions, has done two things. They've propped up asset prices of equities and other things, and they have kept interest rates down. Has that meant that people who would otherwise be in safe, secure bonds have migrated up the risk spectrum?
That's exactly what it means. People that counted on retirement, making 3%, 4%, 5% in bonds or CDs, it's just not possible. So they're being pushed either into equity stocks that pay dividends or higher risk fixed income. Again, I don't know how this ends. I'm worried about how it ends. Our investors are worried about how it ends. We'd love to see the Fed start to slowly unwind some of the stimulus, and that's what our clients are telling us they want.
So that's your message to presumably the new chairman, Ms. Yellen.
Well, they're a lot smarter than I am, so those decisions are above my pay grade, but I can tell you what our clients are saying, and they're saying it's time to back off a little bit of the medicine.
Well, Bettinger's comments about investors' appetite for exchange-traded funds are backed up by some hard numbers. In a survey for the conference, 55% of investment advisors say their clients want more low-expense ETFs and index funds in their portfolios. Susie?
Tyler, now turning to thousands of miles away in China, a key meeting is underway with Chinese leaders to plan the future path for that country's economy. It's known as the Third Plenum. This secret closed-door meeting of Communist Party leaders takes place every 5 years. Now, some China watchers are predicting this gathering will result in big economic and social changes.
Well, those leaders probably welcomed a report today showing China's economy is picking up strength. Industrial output at Chinese factories rose more than 10% in October. The gains were far more than expected and adding to recent data showing momentum in China's economy.
Our next guest just returned from China, where he met with Chinese policymakers and business leaders to talk about what reforms to expect from the Third Plenum meeting in Beijing. He's Robert Hormats, former undersecretary at the U.S. State Department, and he's now vice chairman at Kissinger Associates. So, Bob, a lot of talk about this meeting having big breakthroughs, bold reforms. Is that what you're expecting? I mean, what did you hear from the people you talked with in China last week?
Well, I think most Chinese who are engaged in this are not predicting very bold reforms. For instance, 1978, you had Deng Xiaoping's major reforms opening up China and introducing a dramatic series of changes to make the economy more market-oriented. This time, the key words are comprehensive and deep. And I think they need to cover a wide range of things. They need to improve the efficiency of the banking system to make sure that capital goes to more efficient uses rather than largely state enterprises. They need to free up the deposit rate so depositors will get a more market-oriented rate. they need to make some changes in the capital account to allow a greater degree of inflow and outflow of capital. They need to improve opportunities for state and local governments to obtain revenues, because now they engage in very unwise practices about selling land and giving it to developers, and they don't have their own sources of revenue, so they have to do this, and this disturbs a lot of people whose land is being confiscated. So there are a wide range of issues that need to be addressed.
But Bob, what does this mean in terms of economic growth? I mean, one of the things that we heard from a lot of the CEOs of American companies this earnings season is that their profits were impacted by slower growth in their China operations. So there's this hope that there will be more liberalized business practices in China, or some efforts to boost economic growth. Are we going to hear any of that coming out of this meeting?
Well, there are a lot of points in what in your question. One, there will be greater liberalization. There'll be a reduction in regulations. It'll be easier to make investments. There'll be less elements in the government approval process for lots of business transactions. So the economy will be more market-oriented. And that should help growth. At the same time, there's a lot of excess capacity, and the government is tightening up credit to help shrink that excess capacity. They're also going to try to reorient capital from less efficient to more efficient utilization purposes, like away from state enterprises and the private sector. But the government has said itself that it's not going to go all out for the kind of growth that it had a few years ago, 9 and 10%. They're going to go for around 7.5% to enable this transition to take place smoothly and enable this pressing down of excess capacity to take place, and to deal with environmental issues. The difference for American business will be the kind of things that China will buy. China's less export-oriented than before. The kind of things they buy will be high-end consumer goods, capital equipment to make more high-quality technology products rather than the more traditional capital-intensive products of the past.
So how can U.S. businesses and investors act on this new information? I mean, is this a game changer in terms of doing business with China?
It may not be a game changer. It may not be quite as dramatic as these so-called third plenums of the past, but I think it will put China's growth, if it works, on a steadier stream, a more secure stream of growth of around 7.5% to 8% for the next several years. And investors should look at the compositional changes. That is to say, the kind of things China will buy will move from raw materials and the sort of heavy capital-intensive kinds of equipment to other things that are more technology-oriented, and higher quality consumer products will be very important if consumer growth increases.
All right, I know it's a secretive meeting, but we should know in the next day or so any headlines coming out of the meeting, right?
Yes, it may take a little time, but we should hear a press conference at the end of the meeting, and then there'll be a plenum report sometime in the next several days, but perhaps not right away.
All right, we'll see what happens. Thank you so much, Bob. Always a pleasure to get your analysis.
Thank you. Thanks.
Robert Hormats, former Undersecretary with the U.S. State Department.
All right, Susie, thank you very much. You know, today is 11/11. It's known as Singles Day in China, sort of their Valentine's Day, when single gentlemen are encouraged to confess their feelings for someone special, and everyone is encouraged to shop online. This year, Chinese consumers spent an estimated $5.1 billion on Singles Day gifts, most of that from the website Alibaba, partly owned by Yahoo, and that broke a record for e-commerce sales on this Singles Day.
Well, over in the oil markets today, a lot of talk about Iran and those weekend talks in Geneva. Negotiations over the past 6 days between Iran, the U.S., and 5 other world powers ended without a deal on Iran's nuclear program, which could result in the lifting of sanctions against buying Iran's oil. Well, those talks are expected to resume in 10 days. Meanwhile, with no deal reached, oil prices rose a bit today, closing just above $95 a barrel.
Gasoline prices continue to slide. The Lundberg survey reports that over the past 3 weeks, prices at the pump have fallen nearly 15 cents a gallon to a nationwide average of just $3.22 for regular.
And still ahead on the program, Amazon's wish list, Sunday delivery. It's now available in major cities, but is it enough to deal a blow to Amazon's biggest competitors? But first, here's a look at how the international markets closed today.
Bank of America is engaged in settlement talks with government-run mortgage giant Freddie Mac after the bank was found liable for fraud over faulty mortgages sold by its countrywide financial unit. The government is seeking $864 million in damages, and a deal would shield Bank of America from any future so-called putbacks of mortgages from Freddie Mac stemming from loans sold before 2012.
The world's biggest online retailer is teaming up with the nation's biggest delivery service for something that has never been done before: door-to-door deliveries on Sundays from the post office. John Fort has the story.
When Amazon got its start as a bookseller, the biggest parts of its pitch were price and selection. But now that it's expanding into selling practically everything, speed is as important as ever. And that's why today's news is especially important for the company. Working with the Postal Service, Amazon is beginning to roll out Sunday package delivery, starting with the New York and LA areas. For the Postal Service, it's the rare headline that might actually make customers happy. After plenty of talk about cutbacks on Saturday mail service and price hikes to 49 cents to send first-class mail, Amazon expects to offer Sunday delivery at no extra charge. So for the Postal Service, which had nearly $12 billion in revenue from packages and shipping last year, it's a boost to a growth business. What's in it for Amazon? Loyalty. Prime subscribers order from Amazon more often. With Sunday delivery, they're likely to be happier with the company.
So in our retail business, we know, for example, that 10 years from now, people are still going to want low prices. We know they're still going to want fast delivery. We never have to worry that we'll wake up 10 years from now and the customers will say, Mr. Bezos, I love Amazon. I just wish you delivered a little more slowly. That's not going to happen.
And what'll this do for Amazon's bottom line? It probably won't help in the short term, but it could help the company continue to grow faster than competitors, which is what investors want to see.
I just think this is a win-win for both Amazon and the United States Postal Service. I think that by offering a number of different ways to get products to consumers, I think that's a huge win for Amazon.
We'll have to wait for Amazon's next earnings call in January to find out whether Sunday package delivery was a hit for Amazon, but either way, it seems like the reindeer won't be the only ones working overtime this season. For Nightly Business Report, I'm John Fort.
Drug maker Shire is shelling out $4.2 billion to buy ViroPharma, and that's where we begin tonight's market focus. The Irish company Shire is placing big bets on the market for treating rare diseases by acquiring ViroPharma, a biopharmaceutical firm that specializes in unusual disorders. The purchase price is almost 30% more than ViroPharma's Friday closing price. Shares of ViroPharma surged 25.5% today to $49.42 on the news. Shire was up a fraction to $135.39. Well, a lack of diversity in Eli Lilly's pipeline is worrying analysts at Goldman Sachs. Goldman downgraded the drug maker to sell from neutral. Analysts also cited upcoming patent expirations and a weak outlook for new drugs. Shares of Eli Lilly fell a fraction to $50.28. Susie?
Transocean and activist investor Carl Icahn finally reached an agreement after a months-long proxy fight. The oilfield services company agreed to pay a dividend of $3 a share and to shrink the number of seats on its board. Now, Icahn owns a small stake in the offshore driller and says that the reason he went after the company was over problems with development strategies and mergers. Shares of Transocean popped 3.5% on news of a resolution. It closed at $55.37. Facebook director Mark Andreessen's firm sold 1/3 of its stake in the social media company. That's according to an SEC filing. The venture capital firm still holds more than 4.5 million shares of Facebook. The stock dropped almost 3% to $46.20. And GoGo shares are going up. That company provides in-flight access and reported a smaller than expected loss and better sales. GoGo also boosted its full-year profit and sales guidance as more airlines are signing up for its services. The stock surged almost 29% to $24.15.
FedEx is helping survivors of last Friday's Typhoon Haiyan in the Philippines, believed to have killed upwards of 10,000 people. Federal Express says it is working closely with disaster relief organizations, including the American Red Cross, the Salvation Army, and Heart to Heart, to donate the transportation of equipment and supplies to impacted areas.
Washington state lawmakers voted to extend nearly $9 billion in tax breaks through the year 2040 to the aerospace agent Boeing. They are looking to entice the company to build its new 777X passenger jet at a facility outside Seattle. Boeing has yet to announce where it plans to build the new aircraft.
Meantime, lawmakers in Illinois are considering extending $53 million in tax credits over the next 15 years to Office Depot after its planned acquisition of rival Office Max, which has 2,000 jobs based in Naperville, Illinois. Office Depot will decide whether to move those workers to its current home base in Boca Raton, Florida.
But Tyler, Illinois may have bigger problems. The Fitch Ratings Service has downgraded some $8.5 billion worth of municipal bonds issued by the city of Chicago, cutting them 3 notches lower. Now, it is the latest recognition of a massive pension crisis in America's 3rd largest city. And as Scott Cohn reports, Chicago is by no means alone.
The city of the big shoulders has a giant albatross around its neck.
Our pension debt threatens all the investments we've made in the past 2 years to reform and strengthen Chicago for the future.
That's Chicago Mayor Rahm Emanuel, who told the city council last month that the city is recovering from the worst of the recession, but there's that one big issue.
We must deal with our looming pension crisis.
A $27 billion crisis. That's the shortfall in Chicago's 6 employee pension funds.
We cannot allow the future to become a stark choice between a pension payment or a police officer, a pension payment or a parks program, a pension payment or a school principal.
But that's already happening. With 1,700 fewer police officers on the street than there were 5 years ago, Chicago is the murder capital of America. Pension risks overshadow recent fiscal improvement, wrote Fitch in downgrading Chicago's debt. Emanuel is negotiating with the unions, and he's proposing new taxes and fees to shore up the pension funds, which Chicago has been shortchanging for years. And in that respect, Chicago is hardly unique. Virtually every municipality in America is facing some sort of pension issues, some estimates as high as $4 trillion. After all, when the economic going gets tough, one of the easiest things to put off is a payment to the pension funds. John White heads the PFM group, which helps cities clean up the mess.
Pretty much everyone who has a pension problem skips payments, and that comes home to roost.
And pensions are just one of the issues facing America's cities, which together make up 85% of U.S. output. There's aging infrastructure, budget cuts, an economic engine that's sputtering. Scott Cohn, Nightly Business Report.
Now, all next week, Scott will be crisscrossing the country, highlighting some of the other issues facing America's cities. 5 cities, 5 issues in 5 days.
And coming up, how businesses large and small are helping veterans transition from active duty to a civilian job. But first, how commodities and currencies perform today. The bond markets closed today for Veterans Day.
It's Veterans Day, and sadly, many of the nation's vets, transitioning service members, and their spouses are currently unemployed. But the initiative, Hiring Our Heroes, has been making big strides in changing that. Hampton Pearson has the latest.
After laying a wreath paying tribute to America's veterans at Arlington National Cemetery, President Obama said now is the time to focus on the next generation of veterans coming home from a decade of wars in Iraq and Afghanistan.
Our time of service to our newest veterans has only just begun.
Jason Boyle spent 10 years in the Army, including 2 tours in Afghanistan. But when the infantryman came home last year, after a medical discharge due to combat injuries, he spent 8 months searching for a job, his service and sacrifice overlooked by potential employers.
They just overlooked me. They were like, okay, well, yes, you're infantry, so anybody can hold a gun and go to Afghanistan. What is your other skill set?
He and his wife were on the verge of losing their military health insurance and exhausting his separation pay when Jason decided to go to one more job fair, where he got a job with a Richmond, Virginia area telecom company.
It was life-changing. The night before we went to that that career fair, I was laying in bed crying because I didn't know what else to do.
In the next 5 years, an estimated 1.5 million service members of the post-9/11 era will be making the leap from active duty to a civilian job. Their unemployment rate is 10%, well above the national average. For vets under 25, the unemployment rate is closer to 20%. 2 years ago, the U.S. Chamber of Commerce launched the Hiring Our Heroes initiative, launching job fairs in all 50 states and partnering with businesses large and small.
The Pentagon, VA, they're all estimating that it could be anywhere from 280,000 to 300,000 service members that are going to be transitioning each year for the next 5 years. And that doesn't include their spouses. So we're going to see a significant number of post-9/11 veterans that are all going to be looking for jobs over the next 5 years.
The message from veterans to potential employers: give us a chance to take what we learned in the military to prove it can apply to jobs in the civilian economy. For Nightly Business Report, I'm Hampton Pearson in Washington.
And that is Nightly Business Report for tonight. I'm Susie Garib. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll hope to see you right back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garib with the Nightly Business Report News Brief. On Wall Street, stocks kicked off the new week to the upside, but with the bond markets closed for the Veterans Day holiday, trading was subdued. Still, the Dow added 21 points, enough to mark a new record close. The Nasdaq edged up a fraction, and the S&P added 1 point. No deal after 6 days of multinational talks over Iran's nuclear ambitions. So oil closed above $95 a barrel, even as gasoline prices fell 15 cents a gallon over the past 3 weeks. Amazon.com is teaming up with the U.S. Postal Service to begin deliveries on Sundays in New York and Los Angeles. And the number of smartphones is forecast to triple by the year 2019, accounting for 3 out of every 5 cell phones. Be sure to tune in to Nightly Business Report right here on your public television station.